Hi, I'm Frank Notaf, Chief Economist of CoreLogic. If you have looked at the rental apartment market recently, whether to rent an apartment yourself or to invest in a building, you are likely to have noticed that apartments are more expensive and less widely available than a few years ago. That's the case in most metro areas around the country. Namely, rents are up and vacancy rates down, and we see it in the data. The National Multifamily Housing Council conducts a quarterly survey of apartment building managers and owners and asks them whether the rental apartment market has tightened or not in metros they follow. For nearly every quarter over the last 5 years, rental apartment conditions have gotten tighter, meaning that rents have risen and vacancy rates have come down. In most metro areas in the country, the rental apartment market continues to tighten. These survey results are consistent with broad market data. For example, as measured in the Consumer Price Index, rent was up 3% during 2015, compared with virtually no inflation in the rest of the index. And the Census Bureau has reported that rental vacancy rates are at their lowest levels since the 1980s. Developers have responded to these economic forces by increasing construction of new rental apartments. New building has ramped up after the Great Recession trough. And rental apartment starts in 2015 were at the highest level since 1986. And while some new buildings come with additional amenities, the typical apartment under construction today is about 1,100 square feet per unit, about the same size as in 1999 when measurement data were first compiled. Even though vacancy rates are the lowest in a generation, it's natural to wonder whether there are enough tenants to rent the increased supply of new apartments. Absorption data, which measure the occupancy rate of newly completed apartments, indicate that demand has been sufficient to lease the new units relatively quickly. 3- and 6-month absorption rates are at their highest levels in a decade. In fact, for rental apartments completed during the second quarter of 2015, nearly 2/3 were rented within 3 months. The high level of new starts last year means that 2016 will have an even larger number of new apartment completions. In some local markets, the new supply has already alleviated tight conditions, leading to slower rent growth and greater availability of apartments. More metros will experience rent moderation and vacancy rise in 2016, and competition for quality tenants among building managers will intensify. While national data will likely show relatively low vacancy rates and rent growth that's faster than inflation, some metro markets will begin to see looser conditions. Thanks for your time. For more on CoreLogic's perspective on the U.S. housing economy, please visit the Insights area of CoreLogic.com.